Thank you very much for joining us. My name is Jolene Olson. Outside of this webinar, feel free to email me if you have any questions regarding your membership or the Factor service. Welcome, Peter.
Yeah, thanks, Jolene. Hey, Happy New Year, everybody. Welcome to 2024. Adios, 2023 was an interesting year. What I want to do today, and when we think in terms of being on here for an hour and a half, I'm not sure, it may be an hour, it may be two, not really sure. We'll see how it goes here. I'll try to limit it to an hour and a half, and that, of course, will include time for questions that you might have. Very open to whatever question you have. Don't be shy. As I kind of go through these things and something comes to mind, go ahead and send your questions to Jolene, and she'll line them up for me to answer them at the end. What I want to do today is really go through two things. First, I want to take a look at the factor prop account 2023 and go through the metrics and cover those things which I consider to be important statistical measures of trading. I'll make comments on them, and actually this year I'll make quite a few comments on the metrics as we go through and try to combine the trading performance of the factor prop account with the charts as they unfolded during the year. And then I want to then go through the best dress list for 2023. Longtime Factor members know that best dress list is something I do every year, where I go through the markets I trade, which is primarily futures and Forex and the macro cap cryptos, and take a look at those charts which really are standout textbook examples of classical charting principles based on Richard W. Schaubacher's 1934 book and McGee and Edwards' 1948 book, which really are the textbooks that have modeled how I have traded futures markets since really all the way back to 1978 is when I first started using classical charting principles for my trading. And so we'll go through these two things. So we'll start off here by looking at 2023. In 2023, the factor prop account is primarily the business account. It is the capital that is used for trading the speculative markets I trade for factor research and trading. The factor prop account in 2023 returned 38.6%. And when you take a look at the year, I had a great first 4 months, 4.5 months. It was, and then I took off almost a month, a little over a month of trading where I didn't trade. My wife and I went on a long trip to Europe. It is the longest vacation period I have had as a trader. I have never taken, except for 1987, that much time away from the markets and just not really knowing what markets were doing, not paying attention to the markets, but just not being tied to the markets, not trading. Then, after I came back from Europe, a long, choppy, sideways period, actually 3 out of 4 months during these summer months were either neutral or down. Went through a drawdown of just a little bit over 3%. I want to talk about how I track markets. I track markets based on sequential closed trade net asset value. And so what I do sequentially as trades close, that trade represents, a closed trade represents a percentage. It's not a percentage of the margin used for the trade. It's not a percentage of the underlying value of the market I traded. It's the profit or loss relative to the total capitalization of the factor prop account which during 2023 was just somewhat north of $1 million. And so as each trade closes, it is plotted on this chart relative to the contribution cumulatively. Now, when it comes to reporting profits to the Internal Revenue Service, as a U.S. citizen, of course, it is not a sequential closed trade NAV. It is always marked to the market. And so, for the purpose of taxes, uh, uh, open trades are looked at and treated as taxable events. But in terms of me tracking the performance of the factor prop account for futures, forex, cryptos, and equities, I use this sequential closed trade model. Now I want to take a look at the metrics. These are things you've seen before, but these are really what I consider to be the key indicators uh, of how the year went, and I'll just cover them one at a time and make comments as they come up. For 2023 win rate, and I keep track of win rate, I guess because I always have, but as I have mentioned many times, I think win rate and rate of return are the most overrated metrics of trading. Win rate, I keep track of it because I have, but I know that there are many aspiring novice traders who are obsessed with win rate. Win rate is really a relatively meaningless metric, although my win rate at 54% in 2023 was very much in line with the win rates going back to 2014. And I track this back to 2014 because it really represents the inception of the factor service. For many on this line have been subscribers all the way back to when we brought the factor service and offered it to the public in 2014. And so that's why the metrics go back to that period of time. Now, trading frequency, 230 tranches. Now, when I look at this number, this always represents closed tranches. And in most cases, I have two tranches for each trade I put on. In some cases, it's three. In some cases, it's only one tranche. And when I think of a tranche, really, I think of a two tranche trade where each tranche has a risk of somewhere between 30 and 40 basis points, or 0.3 to 0.4% of capital, or put it in in terms of dollars. When I put on a trade, it's a trade that has a risk of somewhere between $6,000 and $8,000 divided into two different tranches. So 230 tranches, that's a higher level. That's roughly, it's roughly about 130 trades, or somewhere less than 3 new trades per week, between 2 and 3 new trades per week. A little bit higher than I really want to be, and I'll talk about that a little bit later. Average gain for profitable trades of 42 basis points. That's way off the mark, and in fact, tied with 2019 at about the lowest average gain per profitable trade during this period where these metrics represent. Average loss of losing tranches was 13 basis points. The ratio of win size to loss size at 3.2. That's 25% below the benchmark, and it's the lowest in the 10 years of the factor service. So I'm going to talk a little bit about this because I've got some concern with this 3.2. It's a respectable number. Don't get me wrong. I'm not unhappy with win size to loss size ratio of 3.2. It's an excellent number. However, it's a number that has deteriorated from recent years. And whenever I see a deterioration in metrics, I want to get a handle on why that might be and what can be done about it, if anything. Rate of return, I had mentioned 38.9%. Profit factor. Now, what's profit factor? Profit factor is the cumulative total of wins of all profitable trades divided by the cumulative total of all losses. Now, uh, if I do that just mathematically, it ends up being a negative number, of course, because the cum of the loss is a negative number, so you do the division. So it's really the absolute value of that equation. That's 3.9. Again, it's a low number for me, and it's a number that I'm reflecting upon as we start off a new year. Just looking at the uh, Pareto very much in line with the largest 15% of the profitable trades, accounting for 83% of the net profits for the year. And the average basis point profit of my bottom liners, that's that 15%, 93 basis points. That again is a number. So in general, I have some metrics that all add up to be very profitable trading, but yet when I look at them historically, they're numbers that represent some deterioration from the benchmarks. And because of that, is just things that I will be concerned about here as we go forward and want to be giving thoughts about. Here's just a couple of tables, again showing win rates historically going back to 2014 and profit factor going back to 2014. Again, a 1, 2, 3 years of declining profit factor. It is something that, in my mind, I want to get a handle on and know why. But now, here's the thing that really I want to reflect upon is if I think in terms of what might I had done differently that would not have given me some deterioration in the metrics. It's easy to want to change your trading based on what happened the last trade you did or the last 10 trades you did, and I'm always very cautious of that. I change the way I look at trades in terms of trade identification, in terms of the trading rules that I used for trade management. Is I'm always very hesitant to make those changes because I don't want to throw the baby out with the bathwater. And so there, as I think through deteriorating metrics, still very profitable metrics, but some deterioration in those metrics, there are a couple things that in my mind might account for those numbers for 2023. I mean, one fact is I'm comparing it against 9 years of really my most solid performance as a trader going all the way back to 1975. And so it's a little bit of an unfair comparison because I'm comparing some of these trading metrics against years that really represent the most solid string of years that I've had as a trader back to back to back since I became a career trader. I think another reason why they might have been some deterioration in the metrics is I really missed the two biggest trends for the most part that occurred in 2023. One of those trends came in the softs: London cocoa, London coffee, big moves up in sugar, big moves down in sugar. And so while I caught some profits in the softs, I really didn't capture the profits relative to the kind of moves that we saw in the softs in 2023. And I think one other market was the NASDAQ, where the NASDAQ really had uh, just almost an historical year, bottoming in January and basically trending higher all year. I had some ins and outs in NASDAQ. I captured bits and pieces along the way, but yet we had some big trends where not only did I not have 100% position or 50% position in some cases sat out pretty substantial moves. The third reason is it was really a year of very non-decisive breakouts. There were a lot of sloppy breakouts, and I will show you those as I go through the best dress list, because some of those really demonstrate that while we had some wonderful patterns, the breakouts really were not as decisive as breakouts have been from my most profitable trading patterns in past years. I think another factor which may account for it uh, is really this lengthy period that I had mid-year, a period of 3 to 4 months, where we had uh, uh, really challenging markets. Well, you take 3 to 4 months out of a year and have flat to down drawdowns during those periods. It's not going to do a whole lot to contribute to year-ending metrics. I think another reason is just a lack of 200 plus basis point winners. I mean, that's really what I want to get when I look at a trade and size a trade properly. If the trade sets up for me and I have my target, in the back of my mind is some, now not over expectation, because I never really want to be overly expectant of profits, but in the back of my mind is a year for me. A good year is a year in which I have 3, 4, maybe even 5 200 basis point wins during a year, and I had a lack of those in 2023. And then I think just another reason is maybe we didn't have quite the markets in 2023 that I've had in previous years. And of course, some years markets are great, some years they're not. So let me just kind of keep moving on here. This just shows the attribution to total bottom line from market categories. The largest profits for me during the year were in interest rates, followed by the grains, followed by the metals, with interest rates combining, 850 basis points of profit, grains 690 basis points of profits total. That's total of all trades in that category for the year. Just take a look at where the big winners were for the year. And by the way, we'll be sending you out PDFs, which cover all the materials we're doing today, not only in terms of the trading metrics for the factor prop account, but also in terms of a best dress list. So you'll get 2 large PDFs from us. Best dress list will be one, and then a comprehensive listing, including the Excel, the PDF version of the Excel format of all trades done in the factor prop account for the year. But you'll see here as we go through, I think these are the largest, I don't know what we have, 13 or 15 of the largest profitable trades, metals and interest rates, grains, interest rates, crypto, grains, soft, crypto. And so you see really where the profits came in. And there was only one tranche here that had a substantial profit, and that was metals, of a tranche of metals, which 215 basis points was the largest trade of the year. And usually, as I mentioned, when I look back at a year, I often have 4 or 5 tranches that are in that 150 to 200 basis point profit. And I didn't have a fair representation of those in 2023. So just again, we will send you all of this. You'll get a copy. The cover page will look like this, but it'll have a comprehensive list. Okay, I want to cover really those charts that I thought were the best representations of classical charting in 2023. And I want to cover these, not just showing you the chart, but try to walk away from each chart I show you with some comments that hopefully will be helpful to you in terms of how I look at charts, how I trade chart patterns, how I size, how I manage trades. And so some takeaways from each chart. when I look at best, in the back of my mind, when I scroll through all the weekly charts after the end of a year, and I look back and I look at all of the charts, that all of the symbols that are on my comprehensive chart list for those examples of classical charting, I don't really care whether it was a trade I'm in or not. I just want to select what I think are the best representations of classical charting. Uh, but I do so knowing that I am hoping when I do this each year that I participated in the bulk of the move of at least maybe 30% of those. I know there's never going to be a year where I show you these are the best dress lists, and by the way, I captured them all. I mean, that's wonderful to think that way, but that's also not realistic. And so I will show you charts, but I will point out on these charts those charts in which I was able to capture some profits, and those charts that for me I completely missed for one reason or another. So we'll start going through these. By the way, I want to talk real briefly why the best dress list. What do I want to? Why do I want to do a best dress list? What's the purpose for me to do a best dress list? It's not just simply to send you a PDF that you can review. It's for my own use. I want to do a best dress list to accomplish certain things. I mean, one of those things again is it's a standard of kind of a look back survey of the past years in terms of how I have done. Was I able to capture, at least to a large degree, 30, maybe 40% of those charts that are represented in the best dress list? Was I able, did I miss some of these? Why did I miss patterns? Did I not see them in real time? Was I too late? Was I a few days too late? And so I didn't participate in the move? Was I not on top of the ball? So I'm always wanting to go through patterns just to make sure and have it be somewhat of a standard in which I can measure my own trading. Uh, and then the ones that I did see in real time, how did I do? But mainly, I want to look at these patterns just to remind myself of the type of pattern that I really want to be capturing. It's kind of like they teach, old tellers in banks how to recognize counterfeit bills. Well, they do it by showing them what real bills look like. It's the standard of what a really good pattern looks like. And so I always want to remind myself at the end of the year, what are the patterns that I'm really wanting to be looking at? The other thing is I want to have a sense for whether markets are trading the way. Was it an unusual year? Did we have patterns that represented market behavior that was atypical of previous years? And what might account for that if that is the case? And then finally, what I have in mind when I look at these is based on the past year's price action, what aspect of my trading approach worked and which didn't. Now, again, this kind of gets back to the baby in the bathtub, is I don't necessarily want to change the way I trade based on what would have worked best in the past 10 trades, 20 trades, past year. I am conscious of what have been the best practices for me in composite as a swing trader. As a swing trader, I really have no interest in catching lows. I don't have any interest in buying the lows. I don't have any interest in selling highs. My interest is in capturing chunks within a move. I want to capture snippets within a move. As a swing trader, that is what satisfies me. So let me go through what I consider to be the best patterns that I can see from the past year. First one was this falling wedge in Apple Computer. This was actually a pattern I did quite well in. You notice that uh, this is the weekly chart, of course, which clearly shows the falling wedge. Now, on a wedge, you need 5 contact points. I see a lot of wedges that are drawn on social media. People identify them as wedges. They're not wedges. And so I think that's why it's important for all traders to periodically pick up their old copy of Schabacher, Edwards, and McGee. Refresh yourself. Read Schabacher yearly. Set out a time of the year. For me, that's always kind of between Christmas and New Year's, where I kind of shut down trading toward the end of December. And I always go back and review the Schabacher book. Take another look at the Schabacher book. A wedge has to have 5 contact points. Here's 1, here's 2, here's 3, here's 4, here's 5. So a falling wedge has 3 lower points, 2 interceding high points. That's what makes up a falling wedge. Now, when we look at this pattern, actually the breakout was on November 6th, where on a daily chart, you can see that we broke out of the wedge. Now, the wedge is a diagonal pattern for me. Because it's a diagonal pattern, not a parallel pattern, I only put on a 50% position. Obviously, you look at these trades and you go, yeah, I should have put on a 100% position. But that's the rule I have. Diagonal patterns do not get 100% positions for me, because diagonal patterns can be tricky, even though this diagonal pattern was just textbook clear. And so I did not have an order in to buy Apple on this breakout day because it was a diagonal pattern. And for me, I want to see a close outside the boundary line, which we got on November 6th. After the close on November 6th, I put in orders to buy on a stop above the November 6th high. The November 7th is when the trade got put on. But it was only a 50% position, obviously. And this, again, is kind of one of those reasons that had it been 100% position, it would have beefed up some of my metrics. But it is what it is. You know, you can always say, well, if only I would have, woulda, coulda, shouldas. You'll always have coulda, shouldas, wouldas in a year. You'll never not have those. And so there'll always be those cases where you're never going to be able to look back as a discretionary trader and say, I traded perfectly this last year, because that's just not reality. It's not the way it works for discretionary traders. But nevertheless, this to me was a great example of a wedge. Now, this is Broadcom, which had a couple things going on. First, we had this big shelf of that came in, very long period, massive period that started back in 2021, and a long extended sideways period that finally we blew out. Now, I want to call this a rounding, a continuation rounding pattern. You could also call this a cup with a small handle, but nevertheless, it was a clear breakout that took place right at the time that I was on a boat sailing around Europe. And this was a pattern I had looked at prior to my trip. But again, one of those examples of coulda, woulda, shouldas, and coulda, woulda, shouldas. That's what years are all about. You miss trades. You're going to always miss trades. In this case, I missed a trade. But we met the target. Then we went into this textbook rectangle pattern in Broadcom. Take a little closer look to this. You know, where we had a false breakout. I participated in this false breakout. I bought the ATR breakout. Notice the breakaway gap we had in Avco. I don't buy that kind of thing because it's my policy not to put positions on within a trading range. I'm a momentum trader. I wait for patterns to be completed. Should everybody wait for patterns to be completed? That's an individual thing. You develop an approach where you attempt to reposition yourself within a pattern. That's a perfectly legitimate way to trade. It's just not the way I trade, even though we did have this breakaway gap, which was a sign of things to come. Bought the breakout. This is the daily chart, got knocked out. And then we had this secondary buy signal, which frankly I missed. I missed it by a day. I actually saw it and put orders in, but we gapped the next day, and 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 so I missed the buy. But we did have this secondary buy signal on December 8th, which, by the way, was a day after earnings. December 7th was earnings day. We had surprised good earnings, but even after strong earnings, you could have still come in and bought the market either on the open after the earnings or waiting for a confirming close on the 8th, which would have been a good buy point. But again, a great example of a classical chart pattern that broke out, failed, but then a very solid secondary buy signal that would have enabled one to position himself successfully. The target here of 1047, by the way, let me just point that out, is whenever I have a rectangle or an ascending triangle or a descending triangle or a small channel that is within a 15% or so range relative to the underlying value of the pattern. In other words, tight pattern, 15% pattern. Generally, I will use a 2x target. If I'm able to put on successfully 100% position, I'll take 50% of that off at the 1x target, with the goal of the other 50% coming off at the 2x target. But in a case like this, where you have a breakout and failure, I still use that old boundary to represent the secondary breakout. I was able to capture some secondary breakouts in 2023. This was not one. Okay, go to the next chart. This is Bitcoin. Now, I had some pushback on social media on the fact that I labeled this as a left shoulder, a head with an abbreviated right shoulder. Some claimed, well, you can't count that right shoulder because it's not equal to the left shoulder. While I like symmetry in head and shoulders, symmetry being that you have pretty much the same height, left shoulder to right shoulder, as well as the same duration, I would prefer symmetry. That doesn't mean to say that an abbreviated right shoulder or even an extended right shoulder does not represent a legitimate head and shoulders. So I saw this as a head and shoulders bottom. Then we broke out, and I would have never been able to ride this head and shoulders to its target, mainly because we then went into this extended rectangle pattern, which again, in my opinion, was a pattern worthy of being a best trust pattern. And then we broke out and went to the target in Bitcoin. This takes a look at the daily chart. Again, left shoulder, head, right shoulder, broke out, went into this rectangle, and then finally broke out. And by the way, when we broke out of this rectangle, we on the same day met the targets of both the underlying head and shoulders as well as the rectangle. This was actually a trade that I did fairly well on. London Cocoa. We had now. I just want to point out this is a massive pattern. I mean, this is a multi-year pattern that went back to 2018. I mean, it's a 5-year pattern. And 5-year patterns, you can't really get cute trading them on daily charts. When you have a massive pattern like this, you have to take into account that you're not going to be able to trade it based on the tight stop. That if you look at a pattern and you see a multi-year pattern, please know that you're going to have to find your timing on a daily chart or maybe a weekly chart. And while this can point a direction for you to be looking for signals, and this is a wonderful example of an ascending triangle on a multi-year chart, definitely worthy of being on the best stress list. These patterns are often, a little bit tricky to trade. Again, the breakout that we had here, where was I? This is a pattern I saw but did not take advantage of because it occurred when I was out of the country. That doesn't mean there was any guarantee I would have caught it successfully had I been around. I could have bought it and got knocked out. There's always those cases. This really then looks at the weekly bar of this same breakout, where you see that when we broke through this boundary, while it was clear on a quarterly chart, monthly chart, when you get back to a weekly chart, you can see that it was a little bit tricky. But we finally did get a confirming bar. Now, on these big patterns, I'll tell you what I'm really wanting to see when we break out of these big patterns is I really want to go one time scale down from the bigger pattern and wait for a full bar outside of the pattern, which we finally had here, where we have a full bar that is outside of the pattern, and that really becomes the breakout point. This now looks at the daily chart. And so as you can see, when we went from monthly to weekly to daily, we can see all kinds of trickiness that would have occurred when we actually had the breakout. This big horizontal line, that is the line that carried over from the monthly chart, just to give you an example of what takes place at that important boundary line. So even though you have just a wonderful pattern on a monthly chart, that doesn't mean it's going to be an easy market to trade if you're actually trading on a daily chart. There's a good chance that I might have caught this, even though the breakout was in May, but there's also a good chance I could have tried it 2 or 3 times, got knocked out at each, and then kicked myself for missing the whole move. Next chart is Nikkei Dow in Singapore. Now, I can trade Nikkei Dow in Singapore, which I do from time to time. I will also trade the Nikkei Dow in Osaka. There is a Nikkei Dow contract at the CME. I've also traded that, but I tend to either look at the Nikkei Dow in Singapore or in Osaka, where we broke through this big symmetrical triangle, 1 point, 2 point, 3 points, 4 points, hesitation, where I like symmetrical triangles when you hesitate at that upper boundary, because it gives you a little bit clearer opportunity to really identify the breakout. These highs, by the way, never really cleared the ATR, and so where the green dot here in is where the buy signal came in. That was really the first day where we had ATR clearance of the pattern itself. And so even though we kind of nicked this upper boundary here for a period of about 2 weeks, at no point here was there an ATR buy signal triggered until we finally saw the breakout take place there. Now, let me just point out something on here, because I did buy this, but then we had a Friday closing loss that took place on May 5th. And as you know, if I have a Friday closing loss on a trade, I knock it out. Even though it did not disrupt the pattern, even though the pattern was still valid, to me, having an opinion on a chart is one thing, protecting my capital is another. And I always take priority over protecting my capital rather than proving myself right on the pattern itself. This is a Mexican peso where we had a left shoulder, head, right shoulder, continuation pattern, false breakouts, finally had a secondary breakout early, first week of January in 2023, after a false breakout on the weekly chart in November and December, finally in the first week of January. And so just pay attention to these. I think one thing that's a takeaway for me in 2023 is to stay with these bigger patterns a little bit longer and be willing to be alert for those secondary breakouts, which really then represent the start of the legitimate move. Here is where the green dot here is that secondary breakout. That's when there was the secondary breakout on the individual daily contract. Now, you got a tricky thing in futures when you're kind of moving from a continuation chart to the individual contract months, because there are times when you don't have harmony. And that harmony may be due to the fact that you have a market that has a steep carrying charge or may even be inverted. And so you lose the harmony between what you see on the daily chart and what you see on a continuation chart. In some cases, you don't see the same thing on the daily chart simply because it's a futures contract that didn't have trading all the way back into where you had bars from the continuation contract itself. So you kind of got to pay attention. It's tricky. Now, when I see a continuation pattern, and it's a pattern on, my preference is there is an 055 continuation chart, 056, and 057. The 055 continuation chart rolls from one futures contract to the other at first notice date. The 056 rolls at last trading date. The 057 rolls based on what the most active contract is. And so my preference is to look at the 057 contract. And if I see something on the 057 contract, then go to the daily chart and look for a signal that's consistent with what I see on the weekly chart. Heating oil. Here we have what Schabacker called a horn, where you have a low, a high, a higher low, a higher high, a higher low. And this is what Schabacker defines a horn. I call it either a horn or a sloping bottom, where we got a clear breakout on July 7th that went and didn't look back. There were a lot of tricky breakouts that occurred in 2023. This didn't happen to be one, where we had a very clear horn pattern. This is the daily chart. This horn also appeared on the weekly chart with a decisive breakout. Here's your 1x. And here again, this is an example of a pattern where I'm going to look at a 1x target as well as a 2x target. Here's a similar chart for Brent crude. It's traded, it's an IP intercontinental exchange where you had an ascending triangle. It doesn't bother me to cut through spindles to make sense of a pattern. I always want to try to seek a horizontal line, even if I have to cut through spindles. Now, I prefer not to cut through a bar. If this bar had closed up here, then that's a predicament for me. Then I feel obligated to try to include that bar in the pattern I'm drawing. If we break out and we open and close below that boundary line, it doesn't bother me at all to ignore that, consider it a premature breakout or an out of line movement, is what Schabacker, Edwards, McGee would refer to that as an out of line movement. You just ignore it. We finally had a completion July 7th. Here's another massive pattern that was completed in 2023 in London cocoa, where we had this massive 14, 15-year rectangle that we broke out of. And I will show you then on a shorter term basis what this pattern looked like. Oftentimes when you have a big pattern and you see a big pattern on the chart, it's difficult trading that big pattern, those multiple year patterns. But when you see a big multiple year pattern, you can then key in on daily charts knowing that you're likely to get a lot of continuation patterns. You get, little boxy patterns, pennants and flags, is big moves off of a big, long, multi-year pattern often unfold with these types of patterns that you can keep your eye on. We're even poised to have another possible one up here in the March 24 contract. Don't know what it's doing today. Here's another soft. It was a year of the softs. It's London coffee, where we had this massive megaphone. One, two, three, four, big megaphone broadening. This is a broadening triangle where we broke out. By the way, I rode this whole move and finally got stopped out of my final tranche of coffee just today in London, but was able to capture this past the target, although I gave it back here a little bit today on the break. Staying with the theme of softs, it was the year of the softs. This is London sugar, where we had this rectangular pattern. Broke out clearly on this weekly chart. Again, this is a case where you develop 1x and 2x targets. And if you can write it to the 2x, that's great. Pattern completed on March 22nd. Again, all of these with some descriptions and narrative will be part of the best dressed list that we will send you later today. Also, London sugar, at the end of the move, we had 1, 2, 3, 4, 5, rising wedge. Again, rising wedge, first contact point's the high. Falling wedge, first contact point must be a low. High, low, then you need the fifth point. I see a lot of people draw wedges that never have the fifth point. To have a wedge, you need that fifth contact point. Broke down, when you break out of a wedge, your target's the low point of a wedge. When you break out of a falling wedge, your target's the high point of the wedge. And so that is how you develop targets. You can develop targets either by taking the width at point 2, projecting that down from the boundary breakout, or I think a better way to do it is just know that you're going to retrace the entire wedge in itself. And so that's what we had in London sugar. I know that a number of factor members, here's orange juice. I'll cover New York sugar here in a minute. Here was orange juice. It's a market I don't trade. I used to trade orange juice. I traded orange juice back in the 1980s, 1990s extensively. It was a good market. I've not traded orange juice in years, but this was a breakout again. This was a year for the softs to have these breakouts of massive multi-year patterns with massive follow-through move. Huge pattern here in orange juice. By the way, I had orange juice this morning squeezed from my own citrus trees. I'll send you a copy of my citrus trees. We are now in harvest. I have grapefruit this year that are the size of basketballs, but love this time of year where about the first of the year we start picking citrus. Here's the Russell. This was a rectangle in the Russell that I had discussed pretty extensively, commenting on this rectangle pattern. But within this rectangle pattern, sometimes within a pattern, a big pattern, you get a pattern itself that is definitely tradable, and this was tradable. This was a tradable left shoulder, head, right shoulder. Now, where you see these multiple shoulders, which in this case, you had a shoulder, you had another shoulder, then you had a shed, and then really your right shoulder took the form of a left shoulder, head, right shoulder. So you had the right shoulder, which was an independent head and shoulders top pattern. When you break out from those, that's a real tradable pattern. And the pattern broke down, and its target was basically the low end of the larger rectangle, which was a target met on October 25th. Here was a left shoulder complex head where you had kind of a double head, a head, an attempted rally, a break where you have a retest. To me, this is just a complex head and shoulders where you had a shoulder, and a double head. Break out and stall, but never really negated the pattern, finally reaching the target in the big market, bull market. And of course, what I saw then here in the NASDAQ was a cup and a handle, and I viewed the big cup with the small handle. By the way, it's a trade that I carried into the new year and then was stopped out of. Here's New York Sugar, where we had a rectangle pattern, little false breakout, finally reconfirming breakout, and a run to the target. This looks at the July contract during that same period, where you had an ascending triangle, false breakout, finally. Then you had another ascending triangle. You have a running wedge, finally reaching your ultimate top. And then you had this pattern, which in my mind appeared to be the possibility of an ascending triangle, but just rolled over. Gave a big sell signal. Congratulations. I know there are a number of you that posted your chart and commented on your short position in sugar during this decline we had late in the year. Congratulations to you. Kudos. Job well done. 30-year bonds, where we have kind of a rolling pattern. Now, sometimes you'll see a pattern like this, and it'll kind of defy description. Other than there is a line that you can draw that has significance. You have a boundary line that's parallel that actually gives this mark tradability. And so what Edwards and McGee and Schabacher referred to this kind of pattern as a common turn. They refer to it as a common top or a common bottom or a common continuation pattern, where we had this and broke through this 122.22 level with a run to a 111 target. It's almost like an M. It's almost like an M-type top. You'll see that period. This looks the daily chart. This is the daily chart of the 055 contract, which is that same pattern where you had a breakout. You had a retest that was a little tricky, but never really destroyed the pattern. Keep in mind, I can't blow this up. I wish this wasn't on a PowerPoint, because I'd like to blow this up and show you, but you might be able to see with my cursor. Always on these patterns, my risk point is to the high of the last full bar within the pattern on one tranche to the high of the breakout day on another tranche, which then got violated on this retest, but never took out the high of the last full day within the pattern, which more often than not is a better place to put the trade. Just keep in mind that selecting stop loss levels for trade is a tricky proposition, and it's a tricky proposition because depending on where you select for a stop loss, that determines your sizing, and it determines whether you might have twice as many contracts as otherwise, depending on where that stop is placed. And so there's always a balance between you want to play it tight so you can have a larger position, but you have to respect the chart and try to have the chart not be negated and continue to hold your position. I'm going to breeze through these. I want to get to Q&A. It's a big double top, M-type top in soybean oil. It was tricky. This is a trade I traded not successfully, got knocked out of it, but the trade worked. And again, as I look at this, kind of my lesson for this year has been, what if the kind of charts we had this year, where we had really good patterns, but it was the second attempt that finally worked? I'm going to school on that. That in the past, these were a lot of charts this year that finally worked, but they worked on the recompletion, not on the original completion. Okay, this was soybean meal. This was a comment. I tweeted quite a bit on the member Twitter stream on this chart, because we had 1, 2, 3, 4, 5. We had a symmetrical triangle that could have broken down. We actually had a breakout which I tried, pause, went back into the pattern. When we go back into the pattern, that's the first sign that we're going to have a failure pattern. We retested the boundary line. We had the breakout. I went long. And I was able to actually, even though this was a tough trade, it is a trade that I stayed with because I was committed to hold the tranche as long as the market remained above the 8-day moving average, and the 8-day moving average continued in an up direction. We finally did meet our target, and then the 8-day finally rolled over. But this is a trade that I was able to sit through because I was relying on the 8-day moving average to manage a tranche of the trade. I was stopped out of a tranche, but I was able to hold a tranche. March T-notes where we had left shoulder, a kind of an extended right shoulder. I did not change my right shoulder. I just felt that we had breakouts here that just really weren't real breakouts. And finally, then we had a confirming breakout where we cleared these bank of highs. It was a go long signal. We met the target. This to me is a pattern that qualified. This is a final. This is Solana, where we had this massive ascending triangle, 0.1, 0.2, 0.3, 0.4, 0.5. Reversal symmetrical triangles and ascending triangles need 5 points. This is Costco, where we had this massive diamond. Now, keep in mind, a diamond is basically an expanding triangle, a broadening triangle, then you have a mast, and then you have a symmetrical triangle. So you have a mast with a broadening triangle to the left, a symmetrical triangle to the right. We broke out, we met the target of this, but along the way, we formed this 4 month channel. Again, it was market that broke out but failed and then broke out again. So that's look. I want to just look ahead here. That wraps up the best dress list. I want to look through, make some comments on charts that I think we could be looking at the end of this year as charts which will qualify for the 2024 best dress list. We'll see. We don't know. I mean, a general rule that I have had over the years is that if I'm going to catch, if at the end of the year I'm going to have, let's say, 15 markets, 15 charts in the best dress list, I will be happy if I have pretty much captured with at least 50% position the bulk of a third of those. If it's a half of those, I'll give myself an A grade for the year. But I also know that to catch one best dressed chart as a real trade, usually I have to take a stab at a couple charts that have the potential to be best dressed, but then morphed and didn't give me one. And so to catch 5 good ones, I'll probably have to try 15. Here's an Nikkei Dow. This is actually kind of going into the year my favorite chart. Is that we had this big symmetrical triangle. We've been working at this right angle broadening triangle. We've been bumping up against this resistance at 33,772. I have orders in. This I think is this is a trade I'm in. May soybeans I shorted yesterday. 1, 2, 3, 4, 5 point rectangle target 1171. This is a trade that I am in. Will it become a best dress trade for this year? I have no idea. I have no idea. And it won't bother me if it doesn't. Look, as a swing trader, I just know that, I'm going to qualify for the Pareto list. The thing that bothers me about this past year is I didn't try enough of those secondary attempts. And because that's really where the money was in 2023, whether it was in softs or interest rates or whatever, the money that I've left at the table in 2023 were those markets that had an initial false breakout followed by a very recognizable secondary breakout, and it was the secondary breakout that went. And so what that tells me is I either need to be more persistent at trying to catch that secondary breakout. And if that fails, that fails. I try it a second time and then walk away and let other people try it beyond that. Okay, another pattern that could develop either as a 1, 2, 3, 4, 5, as a running wedge where we blow out the top, or it could end up as a rising wedge where we blow down the bottom. Hey, I have no dog in this fight. I will trade the chart for what the trade gives me. GLD has been kind of a better pattern than gold futures, where it is kind of respected this upper resistance level at the 193, 194 level. We haven't really been able to blow through it. And so whether my position is GLD or whether something develops in gold futures that gives me kind of a entry point on the daily chart, this is a chart that I think has the potential to be a best dressed. This is XLK. This is the tech ETFs where we've got a cup. We have a handle, brief handle. We've broken through. Now, the better cup and handle is when the handle is below the level of the high of the cup. This actually is a little elevated. It diminishes a little bit from the validity of it. I am not in XLK. I have orders to buy XLK, but I want to see if I can buy it back at the boundary line. And this is Snowflake. Again, I think this is a great pattern. I've got buy orders in above this market, but we have 1, 2, 3, 4, 5-point symmetrical triangle. Using this high off of this midpoint high is really kind of representing the breakout level that I am going to recognize. So again, lessons learned for me. I am going into this year, the question I have, when you go to the lessons you learn, is your goal to make more money? Is your goal really to be better at what I do? Do I want to go to school on the charts just to be more profitable? Or do I want to go to the school on the charts to be a better trader of the chart patterns that are there? And it's the later. I want to excel at charting and trading charts. If money is the bottom line after that, so be it. I don't want to make changes to optimize a factor based on a discretionary look back. I don't want to look back and say, well, I just want to redo everything I'm doing as a trader. The best fit what happened last year. That is not the way I want to trade. But I do think there's real alpha in trading these larger patterns, in giving them a lot more leeway. And that is something I want to be aware of. Now, how that unfolds in 2024, I still have some things kicking around in my head. And one of the things I have kicking around in my head is to kind of launch a third tranche trading. In addition to the 2-tranche approach that I have right now, is to add a tranche, add an additional 30 basis points of risk, but to do it based solely on weekly bars. Now, that creates some problems because then I have some time frame compatibility issues. Is if I say the factor prop account, I'm going to trade the 2 tranches I trade right now, but I'm going to add a third tranche based on the weekly bar. That's not something that comes easy for me. Maybe you can trade multiple time frames all out of the same account, the same pot of money. That's a challenge for me. And so I have set up a separate account at a separate FCM with the idea that I am going to trade in that tranche exclusively off of weekly bars, and that I will stay with those trades as long as the pattern is not destroyed or negated. Now, what rules will be developed to do that? I will let you know because I don't have them right now. I've just kind of, in my mind, I'm committing to the fact that it may take me a half year or even a full year to kind of flesh out the guidelines for trading and tranche exclusively off of weekly charts. But I do know that to be successful doing that, I need to do it out of a separate account, off of a separate order platform with a separate FCM and keep that pure. Now, how am I going to report that to Factor members? I'm working on it. I mean, I'm not going to leave you in the dark on it, but I'm not 100% sure. It's kind of one of those things where I'm not going into the year and saying I've got it all figured out. I'm going into the year saying this is something I am very interested in exploring, and I need to have it flesh out the details for me. And then I'm hoping by the end of 2024 that I lock up that trading tranche very tightly with very specific rules that, should you choose, you could duplicate yourself because they're going to be more specific than kind of the discretionary judgment that I sometimes use in my swing trading. So that pretty much ends it for me, Jolene, if there are members that have questions, but that wraps up what I have to say.
I'm sending you number 1 right now. Thank you very much.
I released in 1989 an MTA journal, Classical Trading Principles. In it, you outlined 2 trading approaches you had back then. I'm wondering about the first approach, every pattern trading. You no longer trade in that way. Can you share the reasons? Is it a change in market behavior or simply that you're tired of trading so many signals? Yeah, I mean, there's that they published it in the journal. What it was a plenary talk that I gave to the Market Technicians Association, which has now become CMT. So, MTA became CMT 1989. I think it was somewhere in Florida. I gave an evening session on trading classical patterns. This was back in the day where not everybody was a chartist like it seems it is today. Actually, back in the 80s, especially back in the 70s, if you're a chartist, you were a rare bird. And back then, if I traded every pattern I'd see, and what that would generally be would be somewhere between 30 and 40 different trades every month. And there was a couple of reasons why I scaled back from this every pattern trading. One is I just think charts became less reliable. And as they became less reliable, it was the shorter term patterns which lost their reliability first, where weekly patterns tended to remain more reliable. And I think that's what we're seeing, and especially saw in 2023, where daily charts used to, back in the 70s and 80s, in 90s, you'd see a weekly chart and you would find that the daily chart broke out and went. Where now you see the weekly chart, and then when you go to the daily chart, you get tricky breakouts. And I think that was one reason. I think the other reason is I just I wanted to slow down. I didn't want to trade so much. Back then, I'd trade. I'd put on uh, 30 to 40 trades. 1 to 2 trades a day. Where now I'm kind of that 2+ a week, and I actually want to head that and make that even a lower number. So hope that asks. Okay, next question. In many creative fields, professional performance slides after the late 40s and declines rapidly after the mid 60s. From your performance, it doesn't seem that way at all. Do you consider yourself an outlier, or is trading actually age unrelated? Boy, I have to think about this. This is a good question. Wow. Um, Great question. I hadn't thought of that. Um, I don't, if it's true, if there's deterioration in performance after the 40s, especially after the 60s, it may be that, an individual kind of tends to rely more on what's been, right? You kind of rely on your laurels rather than stay as sharp as you really can. And actually, it's really been the last 10 years have been the most consistent performance I've had in all my years of training. And consistent in terms of a clumped performance where I used to have huge ranges, do 150% followed by a 5% loss, followed by an 80% gain, followed by whatever. Where now it's I've become a lot more mechanical, and I think the big change was in 2014 when I adopted active and aggressive trade management. Where prior to that, I did not. I'd do a lot of round and trip trades. I'd write a trade up to 90% of where its target was and write it back down into a loss. And so that's really the change that I made in mid 2014 after 2013, which was uh, my largest single year loss ever in the mid teens and the longest peak to valley to new peak drawdown at, I don't know, 18, 19 months. And so, that gave me a lot more consistency. Am I an outlier? I don't know. I mean, I have peers who I grew up trading with at Commodity Corp and at the Board of Trade that still do well. I've got a lot of peers that don't trade anymore either. I just happen to love trading. I mean, to me, trading is a challenge. People say, "Why don't you retire?" And retire in what? I mean, my body is yeah, I probably have a year left of walking left. My body is not in great shape because of the accident and all of the arthritis that I have as a result of my accident. And so, what am I going to do? Collect postage stamps? You do my rose garden? I can't golf. So, hey, I love trading. I love the challenge of trading. If I'm an outlier, I'll take it. How do I select the contract month for trading, such as May contract over April? Okay, there is no April soybeans. And we go from January soybeans, I can't trade because we're in delivery. Now, with ADM, Archer Daniels, I would be able to stay in the January contract because they know me and they know I have a background in cash grains. And so they would be willing to let me take delivery and take a delivery receipt on January beans. I'd retender it. I wouldn't take delivery. I wouldn't actually go and claim the beans at the warehouse in Chicago or Gary, Indiana, but I could take delivery and retender it. Where Schwab or TD Ameritrade or other brokers, they'll kick you out prior to delivery month. So I just like the May chart. I thought the May and July charts made more sense to me than the March chart. And so I chose the May because to me it better defined what my risk was. And so I look at that. My preference is to trade the nearby active month. So my preference would have been to trade the March beans, but the May beans gave me a better chart. How do I decide which rollover method to use when charting continuous metal futures, gold, silver, copper? Nearby contract is not a useful proxy for spot because of contango. You are right. And the charts posted on Twitter and weekly reports have at times used Trade Navigator's continuation. Could you explain the reasoning for choosing those? Well, again, I'll tend to show the chart that I think best represents the overall picture of the chart that gives me the best definition of a pattern. But in the final analysis, I'm going to have to trade an individual contract. So in the final analysis, we could have a breakout of an 057 chart, and I may not take a trade because the April gold, February gold contracts don't really give me a pattern. Doesn't give me actionable things to do. And so that's the problem we have right now, is that, we're close to new all-time highs in the nearby contracts, but not in the back contract months. So what do I do? Well, I've kind of committed myself that my vehicle is going to be GLD. It's going to be the ETF. I'm going to have to trade the ETF. Why? Because that's just, for me, is the cleanest tradable chart that I can see. How do you keep from repeating the same mistakes? I frequently loosen my stops. In other words, gold today, where were the stops for gold, if you don't mind asking? We had a 3-day trailing stop rule. I don't know. Let's see here. See if I can actually pull my charts up and get you to gold here. Take a look at gold. I came into the year long gold, April gold, high day. Okay, keep in mind, this is the day I bought. I bought gold on what I saw was a left shoulder head, right shoulder that might have launched the breakout of the weekly chart. So that was my thinking. Okay, it's a short pattern. It's not a big pattern, but it might be a launch pattern. And so that brought me into it. Now, keep in mind, if I get a 3-day trailing stop triggered and it triggers at about the level I got in, I'll get out. I'm going to take a loss. So we had a high day on the 28th. We closed above the high day low on the 29th. So that's the setup day. The trigger day is the second. That's my stop out day. And so we triggered a 3-day trailing stop yesterday. Now today is follow through, but yesterday was the trigger of the trailing stop, where the trailing stop rule triggered at the price I got in. So it was basically a break even trade. And so that is how I look at it, as I use that 3-day trailing stop rule. Now, the question is, if I'm going to trade this pattern on a weekly chart basis, well, this isn't a good example, but come back to 057, we don't really have a breakout. There's no weekly chart breakout of gold yet. And so, if I'm looking at this and saying I'm going to institute a tranche that's going to buy gold, I have to wait for gold to break out to activate that tranche. Break out of the continuation chart, hopefully break out of something on the daily chart. So, but that's my stop out. I was stopped out of gold yesterday. Regarding average gains, average losses on my metrics, at what threshold do you bucket break-even trades into winners or losers? I kind of do that. I figure less than $1,000 profit for me, right? So that's 10 basis points. So I figure 5 basis points. If it's less than a $500 profit, it's kind of a waste of time, and it's usually disappointing, because if I end up taking a trade off at $500, it's usually because I had maybe a $1,500 to $2,000 profit that I gave back to a break-even trade. And so in a way, it's kind of a bum trade. It's kind of a negative trade in my mind, even if I scratched a little money out of it. And so I figure $500, it's a losing trade. If we don't trade futures, what ETF for Japan? I don't know. EWJ, I think there's an EWJ, isn't there? Keep in mind, this is probably not adjusted for currency. So you've got currency risk. Is not the same pattern. It's not the same pattern because of the Japanese yen translation. Messes you all up, and that's what you get. Can I comment on entering intraday breakout as opposed to waiting for the close? Great question. I mean, I trade intraday breakouts. That's what I trade. I buy intraday breakouts. Now the question is, if I institute, as I institute a third tranche based on a weekly chart, that's one of those things I'm going to have to make a determination of. I will not enter intraday breakout. The question is whether I will enter it on a Wednesday if Wednesday's bar broke out, or do I have to wait for Friday's close? That's one of those things that I want to work out, but I want to nail it down. And I don't have it nailed down. But as I look to add a tranche to trade weekly charts, it will not trade intraday breakouts. I trade intraday breakouts and other things. I get snapped on it at times. You know, it'll whip me at times. But that's just the way it is. I mean, I don't get offended over losses. You know, if I take a 30 basis point loss on a tranche, it's not something that ruins my day. And so I will tell you what ruins my day more is we will go back, let's say, to we go back to Avco. What ruins my day more is not having an order in on this day, but not being able to get in because it just shoots. And so there's a case where I wait and I have it close and I take action the next day. It's gone. I'm gone. You know, I see the close on the 8th, and what I do is I put in order to buy it at the ATR level, which was at about the close. It was at about the close of the 8th, and I end up empty-handed. And so it bothers me more to be empty-handed and have a market just blow out of a pattern and not look back. It kind of falls into what I define as the law of least regrets. You know, looking at gold or looking at some big breakout, let's say the Japanese stock market, it would bother me more if I missed that because I waited for the close and missed out and never got my ATR buy because I don't chase markets, than it would be if I bought an intraday breakout and happened to be wrong. And so I hope that explains any possibility of explaining ATR confirmation. There's a sheet out there. I'll have Jolene put it out there, and it's a graph. Is that depending on the length of the pattern, determines I use a 30-day ATR, average true range. I use 30-day average true range. That's what's here on the bottom here. I mean, that's what I'm showing these bottoms right here. Is what I'll do is when I'm seeing a breakout, I'll determine the 30-day ATR based on the length of the pattern. The longer the pattern, it moves more toward 100% of the ATR. And so that's where my stop is intraday. And so I'll make sure that Jolene recycles that document or puts on the member Twitter the link to that document which shows that. Why did you stay in Robusta trade rather than exiting completely at the target? It was kind of one of those experimental things. It's just I felt like I'm going to hang with it. As long as it doesn't give me a 3-day trailing stop rule, I'm going to just ride it. And so I had made up my mind that as long as there was not a 3-day trailing stop rule triggered, that I was going to stay with the position and see if, who knows, I get double the profit I had. So that was my idea, and it was just that was kind of a one-off. That was just playing with that idea. Okay, how is factor trading structured? What do you look for in an account? Who knows trading companies? What brokers are used to trade some of the obscure futures like those Londonized exchanges? Okay, IBKR. You can do it all through IBKR. Just do not, Interactive Broker, I have an account at Interactive Brokers. I have an account at ADM, which I've had forever. Archers Daniels Midland, I think, is the most counterparty, trustworthy. It's a long-standing member of the Chicago Board of Trade and Mercantile Exchange. They've been around. They're backed by a multi-billion-dollar grain merchandising and food company. I love ADM. And I can trade everything with ADM, but I can also trade everything with IBKR. IBKR is kind of a poor man's prime broker, and they present themselves as that too. Although, it's become a bigger and bigger FCM as time has gone on. They've captured a larger share of market for futures. Just do not trade them for spot forex because their accounting is an absolute mess. I have to sign a document with my accountant every year, finding him innocent of accounting practice because the complication of the financial statements issued by IBKR. Those who trade IBKR know exactly what I mean. They're just complicated mess. They're financial statements. They give me in 50 pages what ADM gives me in 1 page. And so they're complicated tax statements, but nevertheless, you can trade the world through IBKR. And so for these obscure futures, I recommend IBKR. Do I have an opinion on AI either being able to compete with or enhance? I do. I'm fascinated by it. I don't know how that's going to play out. I don't I don't know. I mean, it's kind of, you go back to high frequency trading. High frequency trading has had a big impact on trading, but a bigger impact on day trading than position trading or swing trading. And so, I'm not sure. I'm not sure. It's going to be very interesting. I know that TradingView has a program where their program will identify and draw in patterns, but I would not use that because frankly, I look at the patterns they identify. Those aren't patterns to me. I don't, but will they become better at identifying patterns? Yeah. The problem is we've always had patterns, but they still have to be traded, and one still needs to manage human emotions. It's not the patterns that mess people up, it's their own head. How do I handle action like a bond pattern with early breakout, which then retests deeply within the pattern before working again? I'm assuming you're referring to the top in bonds that occurred. I'm assuming that's your reference. Not sure, but I'm assuming that's your reference. If you're referring to this, we never really had a real deep retest. And again, that's something, we never closed. We never closed back above the boundary line in bonds. Yeah, we broke out. We had a hard retest of the boundary, but not really a hard retest of the pattern itself. We took out the last day rule, which was the 2nd of August, but we never took out the high of the last full bar. So, this pattern never really got directly challenged. Is the pattern retest valid for the first entry, even though it may be a stop out for the initial entry position? Yes. Question is yes. How will you manage this? Let me go back to that. How will you manage this stopping the soybean trade if it retests? Well, I've got 2 stops. I've got 2 stops that I'm using on the bean trade, and I'll show you the pivot points of those stops. So you got two levels. This gap, the gap. I'm risking the gap, and I'm risking the opening price on the 29th. Actually, that drew it off the high on the 29th, or I'm using the opening price. I think it's 13.19, I think is where my stop is. I think I have like a 13.19 stop and a 13.09 stop. And so if we close the gap, I blow half. If we take out the high, or the open price of the 29th, I blow out of the whole trade. So that's where I'm at. It, won't bother me if we move back up here, but I really kind of don't want the gap to be filled, even though it probably will be. I've kind of ridden off half the trade. I'm guessing that half the trade will be a loss, but again, losses don't bother me. The 8-day moving average is just something that tends to be friendly to the time frame of my swing trading. That's all. I mean, what I've noticed over the years is when we have a big Pareto move, when we have a move that just moves and does its thing, the price stays above the 8-day moving average, and the 8-day moving average doesn't turn down. Now, that's not optimized. I have not at some point in the time figured, well, do I use 8-day? Do I use 9-day? Do I use 10-day? Do I use 6 days? Because I don't believe in that. I mean, it's just something that I have latched onto and say I'm going to make the 8-day moving average and figure out how to best use it. But it's by no means. I'm not a believer in optimizing. I don't think you can optimize indicators. Um, you can't optimize trading rules. Optimization doesn't work. Can I review how I set different ATRs? Can review how? Okay, yeah. I mean, here I'll go here. I mean, I can change that right now. I can go down to my ATR. Right now I'm on 30. I have a 30-day average true range. I could reset this. I could reset this to any number I want to, and it'll give me the new ATR. Can I talk about trading addiction? And if a trader has been addicted, could trade normally after working on it? Boy, question. It's a great, boy, is that a great question. Yeah, I mean, there's such a thing as a dysfunctional relationship with trading. I mean, there's no question about it. Um, could I be dysfunctional as a trader? I could be. Have I gone through periods in the past where my trading behavior probably was borderline dysfunctional? Oh yeah, I mean totally, absolutely. And so what I have been able to do over so many years, because I keep losses small, and I keep losses small because I keep sizing small, and I use stops. I use active stops. I don't well, I'm going to wait and I'm going to wait till I get in break even, then I'll cover. I mean, I put in stops. I use stops. I keep my losses small. Except for the early years when I got lucky, I keep losses small. So that's bought me time to learn. I've learned over time, and what I've learned over time is that I need rules to prevent myself from being dysfunctional, and I need to learn to follow those rules. Now, what are some of those rules? Not to put on a trade the day that I see the pattern. If I see a pattern today and it's not one that I had laid out for me Sunday or at least yesterday on the close, I'm not going to trade it today. I mean, I'll earmark it today, but I'm not going to trade it today. And it's not entering market orders. I mean, the reality is I use stop orders, which become market orders, but they're stop orders first. I don't, get FOMO'd and say, I'm going to do something at the market because I'm excited about it. That I over time have kind of reeled in that Peter Brandt, which if allowed would sabotage me at every turn. But there's nothing unusual about that. I mean, I just think every successful trader I know to some degree has had to work on managing their inner beast. And so I think all trainers by nature have a certain inner beast that has to be reeled in. And so I would say it's something that could be worked on, but it's something that only can be worked on if you develop rules which tend to separate yourself from that dysfunction and you can follow those rules. Now, you may set rules and not be able to follow them. Well, that's dysfunctional. So, but I think it's possible. When you re-enter a position that you were stopped out, do you enter with 100%? No, usually with 50%. So if I'm stopped out of a trade, 100% of the trade, I'm back in at 50%. There may be times when I re-enter it at 100%, but it's because there's something that the market gives me that, it might give me a retest and then give me a foot shot or something like that, where I have a really tight stop on an additional 50%. And so there are some times when I can do that. Usually, though, it's 50. Could I comment on resolving dysfunction and following rules, especially related to sizing and risk? I think if one it knows oneself to be subject to FOMO, subject to reacting emotionally to price action, the worst thing that you can become is a day trader, because you open yourself up by the very nature of the fact you're a day trader. You open yourself up to having being led with your emotions instead of your reason and your rules. So I think that you got to commit to become a swing trader based on bar charts. Learn to put in orders and turn off your machine. Um, I think that's really important, to separate yourself from being sucked in the emotion of price discovery. That if you're being led by price discovery, that's the thing that has to be managed. And I just think that you know that's something that I think you just have to find a way to manage the inner beast, because the inner beast wants to sabotage you at every turn. And I mean, I don't know if I know a trader who would be able to tell me, boy, I trust my emotions. I'll go with my emotions every time. I mean, there are some. I know some traders who are great at reacting, um, but I think they're few and far between. Okay, member comment, I see a pattern today. I do not trade it today. In other words, I do not need to be early to make money. I do not need to be early to make money is a personal rule of mine. It's a good rule. Thank you. I mean, that's absolutely right. Hey, keep in mind, there's always going to be another pattern. I mean, the pattern that we become obsessed on today, I think there's a tendency to look at a market setup and think that's the market setup that will make my future. That's the market setup that will make my month. That's the market setup that'll make my year. That's the market setup that will differentiate me between a wannabe and a full-time trader. That's mistaken thinking. That's stinking thinking. You've got to be able to say, hey, if you miss the trade, I'm not going to chase the trade. My order wasn't in. So what? Yeah, I mean, I wish it had been in some of these markets that I looked at, some of the best dress lists. They weren't. Um, and I just accept the fact again that, if I do 30% of the best dressed and capture at least a good chunk, that's a success. I'll grade myself as a B. If I gather at least uh, half of the move of half of the best dressed list, I'll give myself an A. And so, I think it's a matter of expectations. It's a matter of, hey, you're not going to double your money. Hey, I see some of the marketing that's going on, where people, sell you on the idea, well, if you do this, you can make $200 a day. And if you make $200 a day, you make $1,000 a month. If you make, you make 800, you make 4,000 a month, you make 50,000 a year. Hey, commodities and stocks, these are not annuities, folks. These are not interest-bearing annuities. The problem with thinking that you're going to make X amount a day and that's going to make you a year, that's a denial of Pareto. Pareto applies. Pareto rules rule. And so even if you end up averaging $200 or $500 a day, and your goal is $500 a day, and you achieve over the course of a year $500 a day on average, just know that that's going to come from 15% of your trades, because that's just the way it is. And I have yet to have somebody who is not a short gamma trader be able to show me their trading results and say Pareto didn't apply to me, because it does apply. It applies to all flat price traders. Question, I thought I saw Peter comment in Chart Wizards that classical chart patterns no longer work. I'm not sure that that's what I'm saying. I think I'm saying that chart patterns are trickier than they used to be. And I think that I can stand behind the claim that chart patterns don't provide an edge. Now, I use chart patterns because you got to use something for trade identification. That's a reality. You got to have some means to say this is a trade for me. And for me, that's chart patterns. But I don't believe it's the chart patterns themselves that give me the edge that I need to have to be able to give me the performance that I want to have, that I want to achieve. Give me some edge, there's no question about it. There's a small amount of edge that comes in patterns themselves. But charts just are a means for me to be able to employ trade management that cuts losses short and lets winners run to some degree. Not to a perfect degree, but at least that's the goal, is I'm going to let profits have an opportunity to grow, and I'm going to not let losses have an opportunity to become bigger. And that's where my edge is. And the degree to which that edge syncs with patterns, well, then so be it. Okay. Thank you all for joining. We'll get the best dressed document. We'll be out. A document with all performance for 2023. We'll be getting that to you as well. Thank you all for being members of the Factor Service. We value you guys. You're our family. We love you. We love having you be part of the community. And hey, as I kind of unfold here what I'm going to do with another tranche, how I'm going to put rules together, and I hope to be able to do it through the year, and how I'm going to report that, whether it's part of the overall same Excel document or whether I spin it into something different. I still have to determine that, but we'll keep you posted on it. Thanks all for joining me, and you can end it, Jolene.
Appreciate you so much, and it is exciting to have another year with you and starting off another year with you. And we look forward to what this year brings and everything that Peter's doing and the Factor Service. Thank you for being on the member Twitter as well. The engaging and interaction there, I know members enjoy it and appreciate it. And thank you so much for being part of the Factor family. Have a great New Year's and a wonderful January.